Okay, so I hope this thing is recording me. The light is on, at least you guys can see the slides. So we're back to insider trading. As you recall, we were talking about efficient markets, and information is important to efficient markets. And sometimes the best kind of information is insider information. So we're going to talk about this because, sometimes people who become financial professionals get themselves into trouble. So we want to try to identify what insider trading is, at least within the scope of American law. And I suspect Chinese law probably follows suit. So, first of all, typically it's illegal to make profits on non public information. Okay. And what that means kind of depends on whether you owe a duty to the place where you received the information from. Because as you guys are going to find out, sometimes information can leak, maybe not to the general public, but to you, and you can still trade on it so long as you don't have a duty to the firm that has leaked this information. But the general idea seems simple. And the job of academics is to make things complex. So that, I suppose, is what I will do. Basically, the idea is that we don't want people who know something is going to happen with a firm, some good announcement or some bad announcement is going to happen, to enter the market and trade on that information to the disadvantage of everyone else and to their own advantage. Does that sound reasonable to you guys? Well, let me ask you guys this. If you had to make an argument for why insider trading should be legal based on the efficient market hypothesis, could you make that argument? You, young lady in the back in the hoodie. Yes. Repeat. Yeah, can you make an argument for why insider trading maybe is a good thing? Based on the information the prices give us about the world, let us say. I'm not sure what you mean. If it were legal or illegal to make a profit, I think that's what you said. But I'm saying it's theoretically, go ahead. Yeah, I agree with you, but I think my question is sort of to the reason why we make it illegal. We could make it legal, and I'm getting you to try to argue for why it should be. You, young lady in the with the Apple computer in the gray sweater. No, the lady behind you. Yes. Why why would some people say insider trading should be legal? Okay, great. Come on up. No, no, no. The lady behind you. Right here in the you can leave your laptop. Just come over here and sit down. Thank you. All right. The young lady next to her. Yes, you, the young lady I was in the elevator with. Come over here. All right, now, young lady, no, leave your computer behind because I want to make sure you have undivided attention on the slides. That way you can engage with the class. No, ma'am. Come have a seat here in the front. Stand up and then come have a seat. Okay, you, young lady in the red hoodie. Oh, walk around. Walk around. Super answer. That's exactly right. If I were trying to argue for why insider trading maybe should be legal, I could say, well, wait a minute. Their trades help inform us of what the true price should be, right? And if we illegalize traders the trades by insiders, the people that have the highest amount of information to give us Well, those people are going to be prevented from trading on that insider info, making our prices less informative. And as we know, prices are helpful in helping us make political decisions. For example, it's no secret that President Trump, for example, in the United States, frequently looks at how the stock markets are doing. And he is going to alter his policies based on the performance of the stock market. The Federal Reserve also looks to those things. U.S. congressmen, senators, they pay attention to those prices. And so the prices are informative for us, and we can help make them more informative by having insiders trade as part of the ordinary trading business. But we have said in our society that it's just too much of a cheat. Too many people are too many people would get wealthy too rapidly if we were to allow insider trading. And conversely, all of us outsiders, we would have virtually no chance because, we don't have the insider information, so it wouldn't be a fair playing field. Although I will talk about some potential loopholes to that. For example, we do want Elon Musk to have the right to sell his stock in Tesla from time to time because he wants to diversify his portfolio and whatnot. So at some point, we have to let Elon Musk trade, and we do let him trade under certain, exceptions to the rule, so to speak. All right. So typically, the assumption is that most of us make trading decisions based on public information. Okay. And when you make those decisions, you're considered to be an informed trader. Now, that can mean reading various news sites, right? Looking at quarterly reports, the financials that companies release, and so on. Conversations with other investors, your own financial research. This is all perfectly legal in informed trading. There is also legal insider trading. So you have a situation like where Elon Musk needs to, from time to time, dispose of a stock to diversify his own wealth and his own portfolio, and we allow for that. All right. So, for example, insiders can make legal trades if they comply with SEC rules. And basically, the trades must be reported to the Securities and Exchange Commission. And good news, they are available to all of us to look at. So if some of you guys are trying to generate returns that are in excess of, let's say, the market average, one thing you could do is look at the legal trades placed by insiders. So the legal trades placed by Elon Musk, the CEO of NVIDIA, the CEO of Amazon, and so on. So these kinds of insider trades, because they are reported to the SEC, and typically the trader commits to the trade many, many days in advance of actually making it, right? So it's hard to time the market based on certain news. So in theory, this is kind of a compromise with the insiders, allowing them to diversify their portfolios as they frequently want to do, while not taking advantage in the best way possible of insider information. And all of us can benefit from them. It's true, they're going to make the decision before we're going to make the decision, so they'll have a little bit of a timing advantage. But you could look at SEC filings, see the decisions that Elon Musk has made, and then make a decision about whether to buy Tesla or not. Now, what is an insider? I think that's an important qualifying situation. I suppose most of us are probably outsiders. I suspect few of you, work as a CEO of a major Fortune 500 company, but essentially someone who has material non-public information that has a duty to the firm. So on the slide, it just says someone who has material non-public information, but you guys know me, I'm an attorney. So I want to add just a little bit of clarity here. It's not just somebody that's got non-public information. We're going to talk about that. It's somebody that has non-public information and has a duty not to disclose. Okay. So if I'm a really good investigator, okay, let's say I fly, this is what they used to do in the old days. I fly an airplane over your factories and I see that there's no smoke coming out of your factories. And based on that, I short the shares of your stock. That's not illegal insider trading. That's me being a really good investigator. Okay. Even though that information is non-public and I keep that information to myself and it is material, because I don't have a duty to your company, I'm completely unaffiliated with it. It's not insider trading for me to sell that stock. Okay, so the information for those with a duty, in order to be insider information, has to be not known to the public, and if known, would impact the stock price. So things like, bad financials are coming out, or our factories are not pumping out any product. If that's not known to people, that can be considered insider information if held by people who have a duty of confidentiality to the firm. Okay, so if you act with respect to that information in order to make a profit, you can be held responsible for insider trading. So basically, you usually have tippers and tippees, so to speak. So the tipper is the person who has this duty to keep the information confidential, and they divulge it to somebody. So it's both illegal for them to profit off the information themselves, but it's also illegal for me, to call my wife and say, hey, I know this really good information. Why don't you trade on it? That loophole is also closed, because if you open that loophole, of course, that's how everybody would insider trade. Now, the tippee is the person who gets the tip and makes use of that information to profit. They don't, or to attempt to profit. They don't actually have to be successful. They just have to try. So it's typically hard for the Securities and Exchange Commission to prove these cases. What is the proof in a criminal case in the United States? Anybody recall? It's beyond a reasonable doubt. And that's a high burden. So if the tipper and the tippee, right, have a conversation in the hallway that nobody else heard, it's kind of hard to prove precisely what they said to one another. And, they could have just been talking about the weather. But sometimes you can prove it circumstantially if right after that conversation, one of them went out and made a super profitable trade. That tends to indicate that some confidential insider trading information had been revealed. Okay, it's kind of difficult to track the information. I mean, as you might suspect, all of this information changes hands on Wall Street very rapidly if it gets out between a variety of traders. So typically, this is kind of why, even though you have all sorts of electronic communications, frequently, if people really have that kind of information, they will not put it in an email. Okay, because if you put it in an email, congratulations, it's preserved forever. They will find that information out, and the SEC has frequently succeeded in prosecuting individuals who were tippers or tippees via email. Okay, so at the end of the day, this kind of, this is a hard thing to track. And that's why, even in today's world full of technology, some people still prefer to communicate, let us say, offline, face to face, directly to person. So this, by the way, happened to Martha Stewart. So you guys don't know who she is, but she's kind of a popular figure in the United States. She hosts a popular cooking show that a bunch of people watch. And so it was really interesting. So she got this news from her friend, I Am Clone founder, that there was a drug developed by I Am Clone that was being rejected by the Food and Drug Administration. Well, of course, anytime you're a pharmaceutical firm that's trying to cure cancer and your drug goes south, that's going to have negative implications for your stock price. So Ms. Stewart, who was a shareholder in I Am Clone, went ahead and sold her shares. Now, it's really funny because if you think about it, Miss Stewart is probably a multimillionaire. And, we're talking about, well, let's round it up to 4,000 shares. Let's say $60 a share when she sold. So, what would that be? So 40,000 times, so about $250,000. Now, again, this is a TV personality that is on television, I don't know, daily, is making it probably millions of dollars per year. And here she goes trading for what really should have been, she should have just done nothing. All right. She tried to save herself a little bit of money by selling this stock before the rejection announcement. So she sells one day before the announcement by the FDA, and the company goes down roughly 25%. So the only thing Martha Stewart really saved was $60,000. Now I know $60,000 might sound like a lot to you and perhaps even to me to some extent. It's certainly not worth going to prison over, okay? And, she could have just held the stock, taken the loss, sold it, and bought the S&P 500, for example, okay? So what happened next is that she got indicted on 9 federal felonies by the United States government, okay? So her trial began in 2004. There were dismissals of some of the most serious charges, but she was convicted on 4 counts of obstructing justice, which are 4 felonies. Okay, probably she would have a problem traveling to China because that those convictions are on your record, and as well as other places. Okay, so she was fined $30,000, sentenced to 5 months in prison. Okay, probably jail since prison usually serve more than a year. 2 years of probation and 5 months of home confinement. I mean, all over saving $60,000. Now, I'm just telling you, $60,000 is not that much money. Okay, so the fine was maximum allowed under the federal rules. I guess they wanted to make an example out of her, and her broker was fined $4,000 and probably lost his brokerage license. Okay, so she technically wasn't actually convicted of insider trading because she probably was able to get away with it, right? She was able to find clever lawyers to exploit some of the loopholes concerning whether she had a duty to the firm. Okay, so she probably had a duty because she was tipped off by Sam Waxel, who had a duty, right? So the idea, what you see in the slide, right, is that if you're somebody who has a duty to keep the information secret, and then you share that information with somebody else for the purposes of keeping the information secret, it is, or for the purposes of making money, that person you shared it to can't just pass it on down the line because they sort of inherit the duty you had, which allowed you to obtain the information to begin with. But the important thing is that, first of all, she was accused but not convicted of insider trading, but some of her other activities tended to obstruct justice. And that typically means you're deleting files, preventing investigators from getting a hold of them, and so on. And so at the end of the day, she still had to serve a fair amount of time and pay a fair amount of money. The irony is that had she just done nothing, which by the way is a great lesson about the stock market, frequently the hardest thing in the world to do is to do nothing. Had she just done nothing, she would have made money, right? She sold the stock at $60 a share, and then 2 or 3 years later, it went up to 80. So not only did the stock recover from the losses after that announcement, but it actually made money. And so I'm sure Martha Stewart, felt bad about that. And you guys know, as a TV personality, to have your daily show disrupted by a prison term, like that's a huge deal because people get used to watching your show, and now your show is off the air for 5 or 6 months. All of a sudden, people can't watch your show anymore. So there's a really funny video of her with like some gangster rappers or something, and I guess there's a stereotype because gangster rappers rap about committing crimes and stuff. But the people would say, well, stereotypes are fun, but only one of the people in this picture is a convicted felon, and that was Martha Stewart, the non-rapper white woman. So it kind of created a wide-ranging effect. So right here, I want to kind of point you guys to just the importance of understanding these rules. And I haven't read Miss Stewart's case myself, but there is this concept that if you get a hold of insider information by any means, you cannot trade on it. But I already gave you one example when you have an airplane that's flying over the factory smokestacks. Okay, what about a drone? Do you think that changes it? Is that illegal to trade on that information? Drone, the things, little things that fly around and they have a camera on them. Yeah, what do you think about that? Let's see, who shall I call on? You, young lady in the white hoodie. Do you think it's insider information and it's illegal to trade on your videotaping of a factory smokestacks using a drone? Thank you. No is correct, but I was actually asking the young lady in the white hoodie. But yes, good answer. No, because just like an airplane, you're just doing a really good job investigating. All right, let's say you're on a train ride and you happen to sit next to the CEO. Perhaps you even sit next to this person, Sam Waksel, and you overhear on the phone that the FDA is about to deny the drug approval for this cancer drug. Young lady in the white hoodie, would it be insider information for you to trade on the phone call you overheard? All right, come on up, stand up and come sit at the front. You can't just sit there. You got to answer. Just leave your stuff there. Just come sit at the front for me. No, no, no. Huh? What? Yeah, you. Come on up. All right, excellent. So you, gentleman in the black hoodie, what do you think? Insider trading or no? Okay, why? I see, but do you have a duty to the firm? Aha! So, what do you think about that? If you do it by yourself without telling others, what if you told others? Would it be insider trading? Really? Okay, all right. Well, I appreciate your opinion, and it's possible that the Supreme Court of the United States would agree with you, but I personally don't think so. The reason is that you don't have a duty to that company. In fact, you're just a person that was sitting down on a train that happened to overhear the conversation. That usually doesn't pass on a duty to you, right? You're not somebody who is receiving the information for the purposes of stock trading. You didn't even seek the information, it was just thrust upon you. Okay, so it's possible even that Miss Stewart escaped quite a bit of her responsibility because even she didn't technically owe a duty to that firm. She received the information from somebody that owed a duty to the firm, which probably imputes liability to her, but she herself was not somebody that owed duty to the firm, which probably is why the court dismissed some of those counts. Now, again, we can argue about whether that was right or wrong. It's kind of hard to challenge a dismissal for the prosecution due to double jeopardy grounds. But you can kind of, I think that just using the duty analysis, even if you were to go spread that news to your friends, because you never got a duty to trade on to the company to remain silent, you're actually free to spread that information. Okay, what about if you, like in a famous movie called Wall Street about Bud Fox and Gordon Gekko, what if you follow in your car the CEO of some company and see who he's meeting with? Maybe even follow him inside the restaurant to see who he's meeting with. What do you guys think? Insider trading or no? Any thoughts? You, gentleman in the yellow shirt. Oh, wait, no, I missed the gentleman in the black hoodie. You, yes. Huh? It's not insider trading. Why not? There you go. He has no duty of confidentiality. So, if you're an employee, what about if you're working at a firm and you find out that the CEO is meeting with, let's say the president of the United States and you trade on that information? Would that be insider trading? Huh? It is. Good. Why? There it is. As an employee, you have a duty of confidentiality to the firm and so on and so forth. Now, again, these kinds of cases, I have to say, I'm trying to make it simple. but these are things that even federal prosecutors with decades of experience get wrong. So the cases I'm giving you are obvious. It's clear that in Miss Stewart's case, a really experienced prosecutor thought she was guilty of insider trading. The defense attorney thought she was not, and the judge ultimately agreed with the defense attorney. Now, again, when I read Miss Stewart's case, it kind of feels like the classic case of insider trading. But I suspect, without digging deeper into the facts, that because she probably had very little duty, if any, to that firm, and based on that information that she received, the duty that the original, like this Sam guy, Sam Waxel, 100% insider problem. He's got a problem because he is what? He was the founder of IM Clone. So he definitely is an insider. But Martha Stewart, who, to be fair, didn't even have that much of an investment in this firm, calling her an insider is probably a little much. So I would have to review the judge's decision of why he made that call, but just understand your biggest defense is typically that you don't have a duty. Okay. But, the easiest way to avoid all this is to just try not to trade on insider information. But I understand that's a hard thing. That's a hard ask because trading on insider information or quasi insider information, that is insider information, or that is non public information that you yourself have gained through good research. Well, that's taking away your competitive advantage. So that's why sometimes there are these prosecutions that occur as a result of individuals trying to gain an upper hand. And sometimes it is ruled completely legal. So they were able to get a perfectly good advantage. And sometimes you saw what happened to Ms. Stewart. Sometimes you get pinched. Even if you're not ultimately convicted of insider trading, you can be convicted of related offenses and then be held responsible in the federal courts. So, what do we know about the financial markets? Well, in my opinion, and I think in the opinion of the textbook writers, we know more about markets than we know about just about anything else. We have so much historical data about the markets that actual historians envy us, right? The reason, of course, is that people really care. They believe this historical data is useful in predicting future stock price movements. And so this data spans tens, maybe hundreds of terabytes. And if you guys ever do research, you can get daily data, monthly data, hourly data, data by the minute, data by the second. And the more granular the data is on all those trades, the larger amount of space it takes up. But people do purchase this data in order to try to predict market movements and to make the markets more efficient. So obviously, there's been a tremendous amount of exhaustive analysis on this data, and that is true both in industry and in academia. I can stack papers to the ceiling of this room and to the roof of this building on stocks that are on papers that are trying to use this data to predict stock movements. Okay, so we still have to test some things out, right? There are risk adjustment problems, relevant information problems. There are people who just get lucky, okay? And then there's some, data snooping problems, and we'll discuss those here in a bit. So what can we say about market efficiency overall? Typically, short-term price and market movements are difficult to predict, even if you have tremendous amounts of data. And that sort of makes sense. Like I said the previous class, if you could always predict that Microsoft will go up by 10% after it drops 5%, well, there would be just a massive rush in of investors trying to buy when Microsoft is dropping 5%. So that's going to, over time, erase the patterns, making future stock price movements hard to predict. Markets react very quickly to new information, and, it's very difficult to exploit your reaction speed compared to Wall Street because it only takes 20 to 30 seconds for that information to get through. And believe you me, the people in Wall Street pay for the fastest computers. They even install special copper wiring underneath the streets of New York to make sure their trades get to the stock exchange faster than yours. So frequently, by the time you even hear the news, they already knew about it several seconds in advance. And even if you could trade on the news, you wouldn't have very much of an advantage. All right. So it's not obvious how to beat the stock market, which, I know if I hate to disappoint those of you who came in here wishing to be rich. Well, I think you still can be rich. I still think you can be rich even without beating the market. Because even without beating the market, your return is 12% per year, which is pretty good on average. So you don't have to beat the market to be wealthy. But if you came here hoping to learn how to beat the market, that's not actually the purpose of the investments course. If I knew how to beat the market consistently, do you think I would tell you? No, right? If I knew of a pattern, I would just make money off of it myself until the pattern disappeared. And so that's why whenever you see an academic paper that documents a pattern, right? It's typically like several years after the pattern no longer applies. Because whoever it is that found that pattern probably traded on it until it just disappeared completely and then said, okay, now I will say that between 2000 and 2010, buying Microsoft at a 5% drop was always profitable. That makes sense, right? People, just like we have all this technology, but people still exchange quasi insider information verbally. That's the same way with these pattern recognitions. If you are aware of a pattern, why would you reveal it to everybody else and destroy your own competitive advantage? So, on the other hand, there are many implications that can be drawn from the efficient markets, right? Which security you pick is actually not that important. I know that sounds wild and crazy, but stock picking, if you assume the stock price already reflects all of the available information we have about the stock, then that stock should already be fairly priced. You're getting neither an advantage nor a disadvantage at buying that stock at whatever price the market offers you. There's still a role for professional managers because there are inefficiencies that can be found, and what makes the market consistently efficient is whenever there is some opportunity to make money that appears, the professionals rush to it, exploit it, exploit it, exploit it until it disappears, and then the market settles back on to efficient pricing. So that should make you feel good if you ever make an investment, right? You're paying the market price. That price has all of the possible available information that you could know about that investment. So, that's pretty good, right? So, if you make an investment and you did badly, don't feel bad. The investment was fairly priced when you bought it, and you couldn't have predicted the future developments. I guess on the other hand, if you made a bunch of money, don't feel too good. You weren't that smart. That was the right price for the asset at the time. But to me, I think it's fine, right? You could still make 12% on a broad diversified portfolio of stocks, which, that's the path to wealth for a lot of people in the United States. If you ever read the book like The Millionaire Next Door, or you read about people who are like teachers or, just ordinary like grade school teachers that become millionaires, well, there's nothing special that they do. They just invest in the broad diversified portfolio of American stocks for many, many years, and that's the path to becoming a millionaire. In fact, there are more teachers who are millionaires in the United States than doctors. I bet you didn't know that, right? Why? Well, the teachers are capable of being very committed and investing a little bit of money in the stock market each month. The doctor, he wants to drive a Ferrari and look cool. Well, you can have one or the other, but not both most of the time. So I think that the efficient markets are an overall positive in society. So we can also kind of have a contest, and which you're going to take on professional money managers. Okay, professional money managers have at their disposal all their skills, all of these huge computers, all of the data, and I presume you probably don't have any of those. I know you guys have computers in front of you, but those computers are not nearly as powerful as what they have on Wall Street. I mean, we're not even sitting in our Bloomberg terminal room. At least those computers are a little bit faster at delivering you the information that you need. So there are some, really good investment strategies for the retail investors, which is what I keep referencing, right? You can always buy the S&P 500 Vanguard Fund. Okay, by the way, ticker symbol VOO. That's going to track the S&P 500, and then you will get to benefit from the smart allocation of, the stocks, or well, I don't want to call it smart. I mean, it's sort of predetermined by the Standard and Poor's what stocks are going to be in there, but the prices of those stocks are rising and falling within that index based on a bunch of professionals trying to determine what they really should be worth. So you certainly profit from that. So let's look at all the funds, okay, because we have many, many professional fund managers out there between 89 and 2018. I mean, look, there are almost as many funds as there are stocks. Okay, so that's quite a few of them. You can see the total number of funds is rising over time. Now, you've got the dashed blue lines are the funds that beat the S&P 500 over just 1 year. Now, notice, just based on the numbers in the graph, that really that's only like half the firms. So that makes total sense, right? If the market is efficient, half of the people will overshoot, half of the people will underperform, and so then you average out to the performance of the market, right? Okay, so the dashed line shows that only about half of them are beating the S&P 500 over 1 year. Okay, then you've got the solid pink line, which shows all the funds that have existed for 10 years. And you can see that an even smaller proportion of those are beating the S&P 500 consistently. So it's not impossible. I mean, Berkshire Hathaway, for example, has beaten the S&P 500. You can find many other mutual funds that have outperformed the S&P 500. But if you were to pick a fund at random, you'd have about a 50-50 chance of getting one that outperforms. And you might say to me, aha, well, I'll just pick one that's been outperforming for the past 10 years. Well, that's the thing. What we see is that the market returns to the mean, basically meaning that if you've been outperforming for 10 years, typically that outperformance doesn't last. Okay, it's very hard to make it last for a long time. And even Warren Buffett now, who has outperformed the S&P 500 for about 50 years, which an amazing record. He's the best of the best, considered to be the best of the best. This year, for example, he has underperformed. Right? Now, you could say he's 95 years old, he's getting a little bit older. Maybe he will outperform in the next 5-10 years, and he might. But you can see that even though a firm or a fund has been outperforming for a long time, does not mean it will outperform in the future. So it shows that, there are funds that beat the S&P 500, but, there's much variation in that dashed blue line. Okay. And that implies to us that it's hard to do that consistently. Okay. The red line is a little bit of a stronger indicator. There clearly seem to be strategies that outperform the market, and you guys are free to try to latch on to those strategies by buying those funds. Okay. But it's hard to predict how many managers that year will outperform. And, the low level variation of the dashed red line means that there are many managers who beat the market consistently. Okay. And that remains stable. But getting a job with one of those managers, super hard, guys. So you guys can aim for that, and maybe you will be the next employee of Berkshire Hathaway, or, some of these other funds like Citadel, for example. So you can see that, even if, like, when accounting for this, right, for all of the overperformance and outperformance, you can see that if you look at the 50% line, okay, there are not a lot of firms and not in a lot of years where people outperform the S&P 500. So it's super hard, okay? That right there is why I have stopped trying. When I was very young, before I went to go get a finance PhD, I was like, man, if I could think really, really hard, I could beat these guys, maybe. But it's very hard to beat the S&P index, and you can see that many years most people don't even come close. I mean, like right here, only 10%. That means 90% of all the professionals lost to a blind investment in a diversified market portfolio. Okay. Now, it doesn't mean they're useless. They're actually helping us. They're helping the stock prices be precisely what they need to be for the market to be well priced. But their efforts are not frequently rewarded by surpassing the S&P 500 index. Okay, now if you look over the 10-year returns, we kind of have, let us say some better performance here during the periods of financial crisis. And that's not too surprising to me. A lot of those funds, what they advertise is not necessarily the highest return, but a hedged return, meaning that in times of crisis, people don't like to see their portfolio go down by 50% of its value, right? They hate that. So they are willing to sacrifice really high returns in order to have kind of a safe, steady, stable return. And so clearly there are a lot of funds that are offering that, which is why you have outperformance against the S&P 500. But in other years, of course, the price of having this hedged position is that you're going to underperform the S&P 500 when the market turns positive. And so that's more or less what you're seeing in this chart. So I don't know, this could give you some food for thought as to whether or not you want to spend a lot of time or just a little time investing in various equities. Because as you can see, unless, and again, it's fair. When you're young, everybody thinks you're the chosen one, right? Like you think you're the chosen one. I am the one that's going to outperform the markets. But just remember, every one of those hedge fund managers also thinks that. Every single one of those guys thinks I'm the one, right? And you have to think about it. Those guys are the best of the best. Like if I give them my tests, they'd probably get 110%. Like they'd be done in 15 minutes, 30 minutes, and would be turning in this perfect test paper. So those guys are the best of the best. They think they're the best of the best, and yet they underperform the market at a very consistent rate. Okay, so even in this chart, which is favorable, okay, for those, and there's selection bias, right? Can anybody identify the selection bias? Why is this chart so different from this chart? Like in this chart, it feels like there's quite a bit of overperformance, whereas in this chart, the times of overperformance are kind of few and far between, and times of underperformance, seem frequent. This chart seems a little bit better. Any thoughts? You gentleman in the white coat. Yeah, I would agree with that. But is there something about our sample selection that is causing that? You gentleman in the black shirt. Okay. That feels like that would increase our sample. Or would it decrease our sample? Okay. What do you think? Uh-huh. Okay. All right, so you guys are thinking the sample would expand with time, but isn't that sample comprised of firms that have made it at least 10 years? Isn't it? There it is. Some firms go bust. Probably a bunch of firms in this year that underperformed the S&P 500, people just said, "Why am I going to invest in this mutual fund? Forget it. I'm just going to buy the S&P 500 index." So then your business dries up. So what kind of bias do we have between this chart and this chart? And this is important for you guys when you make the selection. Because if you make a selection out of all funds right now, this is the right chart for you, not this chart. Okay, this chart makes the performance of the fund managers look better. Anybody think of why? There is a bias. There's a sample bias for sure. Anybody know the name of this type of bias? Survivorship bias. That's exactly right. You see, these guys are the ones that lived. They're the ones that survived, right? And so, yeah, we can look at them and we can say, oh, well, that's wonderful. And if you buy one of the surviving ones, you can expect that to be, let's say, your average performance against the index. But if you just go pick a fund at random, that's your chart, right? Because you don't know that the fund you pick is going to survive 10 years. And these clearly are the best. Okay, they're survivors because they are the best. They have persevered across time. Now, these guys, not so much, right? So always remember when you're looking at a lot of economic statistics, you know, survivorship bias is important. Another way to think about it is the silence of the graveyards. Okay, so you don't know what happened, what would have happened to the firms that failed because they're in the graveyard, right? And if you've ever been to a graveyard, it's very quiet. So this is an important concept in economics whenever you're trying to measure a whole variety of returns is your sample picking up what actually happened in the population? Because in the population, a bunch of them didn't survive. And so they are silent. Coincidentally, not to demotivate you a little bit, you guys ever get on the on YouTube or Billy, whatever it is that you use to stream videos, and you hear like this inspirational speech, pursue your dreams, give up everything just so that you can achieve what you want to achieve. All this stuff. Never listen to the naysayers. You hear that from very successful people. What's the problem in that sample? Survivorship bias. Those guys survived. It's quite possible that there are many people who did exactly the same thing they did. They never gave up on their dream. They invested everything they had in whatever it is that they believed in, and they didn't make it. And because they didn't make it, they're not in front of the microphone to tell you, actually, if you sell your house to play the lottery, it may not work, right? And so that just means that even though you hear all these successful people telling you, don't give up on whatever it is you're pursuing, it doesn't mean that that will actually lead to the best outcomes because you're missing the part of the sample who didn't become CEO. You're missing, and that's the majority of the sample. I mean, that's 90% of it. Okay, so that's a really, really important concept in economics. And have you guys seen the airplanes? There's a really fun study where the British saw as they were bombing Germany during World War II that the planes had holes in various parts of their wings, right? When they were coming back, they could see the holes. Okay, so they put armor there. What's the problem? Any thoughts?
Stay flying. It's not necessary for shield.
Very close, but why? Why might it not be necessary? Why is it wrong to draw the conclusion that we should add more armor to the holes of the returning planes? Not quite, not quite. Think about the sample. What's your sample in that situation? Where are you getting the data? Are they not important?
Not so important because they
Mhm.
were short, so they can it's also can return. So
Good. What are you missing? What are you missing from that sample?
the place they will not hit.
No, no, you have those. Those also returned. Who didn't return? Who didn't return? No, the planes that came back usually had an engine. There it is. The planes that were successfully shot down. You don't have those in your sample. The only planes that are coming back are the planes that lived. So if you only put armor on the planes that lived where, where the bullets were, where they survived, you're still not addressing the problem of all the planes that went down. Right? And so that's sampling bias, right? So if you don't understand sampling bias and you don't understand survivability bias, again, it's the silence of the graveyard. You can know nothing about the planes that didn't come back. And they're literally in a graveyard, right? So anyway, that's kind of why you're seeing that statistical spread the way that you see it. So anyway, 12 out of the 30 years, more than half beat the S&P 500. Well, that means 18 out of the 30 years, less than half performed better than the S&P 500. Okay, so 10-year investment periods are a little bit better. And 11 of the 21 investment periods, more than half of the professional managers beat the S&P 500 fund. Okay, I mean, that's somewhat better, but still you can see it's about 50%, right? 50 above, 50 below. So data from 89 through 2018, we can divide the time period into 3-year, 5-year, and 10-year investment periods. And we can calculate the number of investment periods where we ask the following two questions. What percent of the time did 50% of the managed funds beat the S&P 500? And what percent of the time did 3/4 of them beat the S&P 500? Okay, let's look at that. Well, you can see that for the entire span, okay, the number of investment funds, half the S&P, half the funds beat the Vanguard index is 12. For 3-year rolling periods, it's 13, 13, and 11 for, all of these, 5-year and 10-year period increments. Okay, so you can see that we're actually below the percentage, right, for most of these. So 40%, that's a pretty significant underperformance. We got a trimmed sample here, right? So 46.4%. Then you've got an even 50 from 1993 to 2018, and the investment period being 5 years. And then you finally get above 50% at the investment period being 10 years. Okay, so again, the professionals are doing all of us a service, but you don't have to invest with the professionals to outperform them just based on the S&P index. Okay, so there are potential difficult questions about the role of these investment professionals. And you guys are going to find that they use things like, well, we have lower volatility or a lower beta to generate their returns to kind of justify their existence. And that works for a lot of people. Some people would rather make 6 or 7% very steadily than 12% going up and down like this, right? Because that can be very stressful. So those are the preferences of some investors, and that's where the professionals kind of make their money. All right. So if markets are inefficient and fundamental analysis tools are useful, okay, then why is it that these guys can't beat the markets? The suggestion is that, well, they're useful if you're trading with a bunch of people who are uneducated. But if you're educated and everybody else is educated and everyone has very powerful machines at their disposal, it's hard to make money just by looking at the fundamentals of the firms. So professional money managers, also burn a tremendous number of resources. And here's the survivorship bias right here, right? And even with the survivorship bias, they frequently don't outperform the S&P 500. Okay, again, if it were possible to beat the market, then the process of elimination should lead to a situation where the survivors can always beat the market. But they don't, right? They don't always beat the market, and there are many funds that have been around for decades that end up shutting down. And think about how much time, how many employees these funds have, right? There's tremendous amount of efforts to try to outperform, and a lot of them fail. So that's what makes the study of finance very interesting, because you kind of have to say, well, of what use are these guys if they're constantly underperforming? Now, a portfolio manager in an efficient market wants to build a portfolio that goes to the needs of his or her investors. Some people want more risk, some people want less risk, and so on, and they're willing to, receive higher or lower returns given their risk profile. So, you want a well-diversified portfolio, but what that means can vary. So, some factors: age, tax bracket, desire for risk, who they work for, right? So, you can think about many things that would impact your desire to invest in various stocks. And you guys are fixing to be part of the workforce soon. So, if you have an employer that's super secure, right? Very secure employment, you can afford to be more risky in the stock market. If your job can be terminated tomorrow or the day after, you can't have a very risky investment in the stock market, because then you need that money in order to support yourself while you're looking for a new job. So that can really make a difference for you. And that's how the financial managers try to make their money. They say, well, the S&P 500 is just a broad average. It's not right for everybody. Let me adjust your portfolio to your specific needs. Okay? So there are many market anomalies you should be aware of. Okay? So these anomalies usually don't involve many dollars relative to their overall sizes. They're fleeting. They tend to disappear with time. Remember, if there was always an anomaly, people would trade away that advantage. And they're not easily used, okay? Because some transaction costs are just too high. In order, it costs money to trade. Every time you trade, you frequently have to pay your broker at least a few dollars. A long time ago, you used to have to pay them 1% of the trade. That's a lot of money. And there are obviously tax consequences of trades. For example, myself personally, I hold a whole bunch of investments that I cannot sell, because if I sell them, I will have to report a capital gain, and I will be taxed on that capital gain at a relatively high rate. So I can keep 100% of that money in the stock market and be taxed zero, or the moment that I sell to exploit one of these anomalies, all of a sudden I owe, $50,000. That's unattractive, right? That's what Martha Stewart lost on her stock. I don't want to lose that. So, okay, let's look at the day of the week effects. So, very interestingly, right? Mondays, people don't like them, and the market doesn't like them either. You typically have a loss on these days. By the way, just on a personal level, I find these fascinating. Like, if on average, if you want to buy stock, try to get it on a Monday, right? That's going to outperform. All right, when should you sell stock? Well, you can look at some of these percentages, I guess, depending on your time frame. You can see Wednesdays seem like a pretty good to sell, and Fridays seem like a pretty good day to sell. Okay. Now, you guys can kind of understand the idea, right? Clearly, there's something behavioral at work. It can't be that things are just worse in the world on Mondays. We just don't like Mondays because we got to go back to work. So people are pessimistic, and their pessimism is reflected in stock prices. Fridays, people are pretty happy. Hey, here comes the weekend, right? So people are happy, prices are up, and so on. Again, probably there's not much difference for many firms between Mondays and Fridays, but there is a difference for investments. After all, we're behavioral creatures, and so we behave in ways that are a little bit irrational. One way you can profit is you can spot the irrationality of others, and you can sell on Mondays. I'm sorry, you can buy on Mondays and sell on Fridays. Okay, but again, every time you sell, there's going to be a capital gain, so that may render the trade prohibitive. Okay, this is my favorite chart. I love this one. Try to buy in September, right? Try to buy, I always try to buy in September if I can. It's the worst time for stocks. So you're going to get the stocks at a discount of, I don't know, what is it here? Almost a 1% discount in September. When should you sell? You can sell in December and January. Those are good times. And you might also sell in July and April. Okay, again, notice as the time periods get larger, the number of times the market is underperforming is kind of small. We only really have one negative month here. Okay? Now, What about the small cap stocks? Okay, these are the smaller companies, not your NVIDIAs. NVIDIA used to be a small cap stock, it's not anymore. It just means the market capitalization puts them outside the top 500, probably outside of the top 2,000 stocks on the stock exchange. So you can see that they have a huge January effect, right? So they have tremendous returns in January and not so good returns at other times. So if you're trading small cap indices, January might be a really good time to sell. And again, September and October, they might be good times to buy. So I like these. And like I said, I can't really sell anymore. Because of tax consequences, I suppose I will just wait until I die and pass the money on to my sons and daughters. And then when I die, they can sell without a tax benefit. Whereas if I sell during my life, that's it. I get hammered with the taxes. So, you know, but if I could, if I was young like you guys, and when I was young like you guys, I would try to trade on these patterns because they're widely known in the stock markets. So we can kind of think about why these things happen. I mean, you can think about human sentiment. People are happy in January. Why? Well, they just got their gifts, right? They got their Christmas gifts and they got their New Year's gifts. I don't know too much about how the Chinese New Year and gift giving period time works, but I feel like it's around this time. People are relatively happy during these holidays. Okay, on the other hand, in September, in case you're wondering what usually happens here, so the fiscal year in the United States ends in September 30th. So, the politicians are trying to get a budget passed, and that makes a lot of people unhappy. For example, what's happening in America now? Nobody knows. I can't blame you. It hasn't had much of an impact on stocks. So what's going on in the United States? Government shutdown, right? The US government has been shut down for 36 days. Yeah, you didn't know that? Yeah, they ran out of money. That's what happens. If you run out of money, you can't afford to pay all your government employees. The US government employees have been out of work for 36 days. Now, it's really funny. This is, I'm sort of a libertarian person who believes the less government, the better. And so in America, we haven't had a government for 36 days, and you didn't notice any difference. that kind of goes to show you that people will govern themselves, at least in America, without government interference. Okay, so we don't have a government, and I was just there, guys. I was just in America. There's no difference when we don't have a government than when we do. Okay, the nation operates almost exactly the same way. Okay, like there were no problems at all. I ate at my usual restaurants. I hung out at my usual spots. I visited my usual friends and relatives, and there was just no difference whatsoever. And to think the federal government in America is spending $7 trillion a year to stay afloat. All right, so the turn of year effect, this is known as the January effect. Basically the 3-week period of the returns kind of forecasts the returns for the rest of the year. Okay, so we've calculated the daily market returns from 62 to 2018, and we can kind of observe this effect. Okay, so this is the turn of the year returns. Okay, and you can see that the rest of the year, the returns are muted compared to the turn of the year returns. So the turn of the year can be predictive. You can use that as a predictor of how the rest of the year is going to go. You can also do turn of the month. Okay, so turn of the month looks kind of like this. All right, so if the month starts off pretty good, okay, that could be an indicator that the rest of the month is going to be pretty good. And I guess if it starts pretty bad, well, you can know to sell off at that time because things are not going to go the way that you had planned. Now, again, this, I agree, is kind of similar to my example, right? If Microsoft goes down 5%, you can predict that it'll go up 10. This seems similar, right? Because you see that the turn of the month return is actually predictive of the future. That means these patterns still exist and you can trade on them. And I encourage you to do that at Interactive Brokers to see if you can make money. Now, you guys know about bubbles. Whenever you hear that there's a bubble, it means people are overpricing various assets. Things are priced higher than they should be. And when the bubble, quote unquote, pops, you have a crash. So everybody realizes things are not as good as they should have been, and the prices plummet. This is kind of how what crashes look like in charts. This is the Dow Jones Index in 1929 during the Great Depression. And you can see that that crash is actually very persistent. It's the worst crash of all time that we have on the books. Okay. There are many economic factors that facilitated, but you can see that there was sort of a bubble and that bubble popped, right? It went through from what? 320 and then at its height 390 down to 40. That's a pretty huge loss, okay? Now, we haven't had as big of a loss since then, but we've still had some very rapid losses. For example, in 87, if you were a Dow Jones investor, you lost more than 20% of your entire investment. Now, again, this is why people don't always just buy the index, because the index can be very volatile. How many of you guys would like to look in your bank account and see that 23% of your stuff is gone and you don't know when it will be back? It's unpleasant. As you guys know, personally, there have been times where I've logged into my investment account and 500,000 was gone. USD. That's a lot of money. I could buy like 2 or 3 Ferraris for that. Okay? And to see that gone from your investment account, that hurts a lot of people's feelings. Now, who thinks I panicked and I sold? Anybody? Oh, no. There's no recovery. You just lost the money. That's gone forever. Okay. So, in my case, the $500,000 loss happened this April. I didn't sell. Look at the markets. Did I get the money back? Yeah. Okay. Do I have more money now than I had before April? Yeah. Because the standard approach, like this is what Warren Buffett kind of champions, is put the money in, don't look at it. Okay. 20 or 30 years later, you should have a way more money in there than what you put in. But if you look at it every day and you trade on it every day, you're going to interrupt the compounding process and your earnings will be significantly less. Okay. So, well, there's the crash. So look, the guys that sold right here, that they really got hurt. Okay. The thing was back just what would it be? 2.5 years later, it had actually made money. So if you just didn't look, like you were completely blind, you didn't look at it at all, you were back to where you had started, right? You wouldn't have even known the difference. But if you looked and a lot of people peaked and they sold right here, that's kind of unfortunate. Also, to be fair, there was a pretty significant rise before the crash. Like this is a bubble, okay? So if you just like didn't look, it would look like the market rose steadily. But in reality, there was tremendous tumult. Okay. So I kind of don't feel bad for these investors because they experienced a very rapid expansion in their wealth. And then when it crashed, it just went down to here. So things were still okay. But people panicked and they sold, and that's kind of how it is. Because there is a lot of panic when markets drop. There are some circuit breakers that halt trading. So, for example, if you drop 7%, 13%, or 20% on the S&P 500 in a single day, there will be a circuit breaker that says, okay, guys, no more trading for the next 15 minutes. And then if it's 20% in one day, which again has not happened very frequently, you will actually halt trading for the rest of the day. And, from the efficient market hypothesis standpoint, I'm not sure if that's good or bad because, yes, possibly people are reacting emotionally, but if the market was a sell 15 minutes ago, isn't it still a sell 15 minutes later? Right? So these circuit breakers try to prevent panics. So, of course, there are panics that happen all over the world. The Nikkei index out of Japan right? It had like a massive 20 or 30-year bear market, right? Only a few years ago did it hit a new high compared to 1990. So typically, I would say the more developed the market is, the less likely it is to have this prolonged period of losses. In the United States, too, about 50 years ago, we had about a 20-year period where the market basically did not make a new high. So it was hard to make money in that market. But again, when we invest in in very risky assets, we typically invest for the long term, and we have to be accountable for that. All right. Dot-com bubble, another very recent bubble. You can see the NASDAQ right here. It fell and it did not make a new high from 1999 to 2014. I actually remember I was beginning to trade when it started to make a new high. So again, 15-year period without seeing much of a return on your investment, that can be hard on a lot of people, and that's why they don't invest. Finally, the great financial crisis of 2007, 2008, you can see that for about a 5-year period, the Dow Jones could not recover. Okay, and so this is sort of what the crash looked like at the Dow Jones level, and it looked, I think, a little bit worse at the S&P 500 level. All right, questions, comments, testimonies. You're free.